Hi friends, hi fellow traders, hi mates. Uh, I'm happy again we've met. In this course, I'm going to share with you very important things to look at whenever somebody thinks about forex. Whenever somebody wants to be profitable. I know it's been a lot of questions almost in everyone's mind for uh, There are 90% of our traders have been losing money, uh, have been complaining. Some have been saying forex is a scam. But I'm here to tell you that forex is not a scam. Sorry. What you need is an accurate information. What you need is a truth, and today we are going to look at some of the important points which most traders have actually overlooked at. All right. So if you are new, you are a beginner to forex trading, this is a course for you. This video is meant for you. If you have been a struggling trader, this information is for you. The skills that I'll review in this, they will change your life. They will change how you look at the forex market. All right. So without wasting much time, if you are new to the channel, please subscribe to the channel so that at least each and every content that I upload, you'll be the first one to be informed or to be notified. Therefore, let's go. So the first lesson we are going to look at is the introduction to forex trading, where we're going to look at what's forex, where we're going to look at what is traded in the forex market. In other way, this one gives you a view what forex is all about. All right. So now, introduction to forex, we are going to go direct to what is forex. We need to understand for you to jump in the forex industry. You need to understand what is it all about. It's very important. All right. So I can assure you that if you watch this video up to the end, it will really change the way you look at forex. It will really change your trading journey. It will really change everything about trading. You will be a consistency profit generator. All right. So forex is a compound word, which is foreign exchange. All right. It's a foreign exchange market in which one nation and the other nation currencies are being traded on the agreed um, certain rate. All right. So forex is run electronically within a network of banks, and is 24 hours uh, in all the 5 working days. Okay. So forex is the largest market in the world of about sorry, here I've put 3 trillion, but of about 5 trillion US dollar daily transaction. All right. And almost 500 billion stocks being traded in the forex market. So, and this is daily, so meaning just even a 0.00% can be yours. That only if you pay attention to this trading course, right? So the business of forex trading, on the minimum investment, you can put whatever amount you want, depending on the minimum investments that particular broker you have an account with accept. Most brokers they allow you to deposit of about five US dollar, others 10, others 30, others 50, others 100. But of course, the others that go as far as 500, depending on your broker. All right, depending on the broker. All right, depending on the broker. Okay, depending on the broker. All right, so but personally, I advise at least you put a $200. That if you be trading with a 0.01 lot size or the minimal lot size your broker allows you to trade with. So You can start with the $200. I think that's a good amount that I advise personally. And on the minimal commitment time, you can commit yourself like every day, just 3 or to 6 hours a day. It's more than sufficient. In fact, like me, sometimes I don't even go as far as 3 hours. Just 30 minutes, I analyze the market, I press my trades, uh, and I come out of the market. So it doesn't need your time, doesn't need much of your time. That's a good part of Forex. And I can do what else you are doing, other works, other thing that you need to do. There are others who are working, they work, but they still trade like they are at their working place. So Forex has many advantages. You can trade anywhere. You don't need employees. All you need is just your laptop, your phone, and the internet. That is it. And you make a deposit. That is it. And you are ready to go. You can trade anywhere, even in the car, you can be trading. Even when you're on the journey, you're on the flight, you can be trading. Anywhere you can be trading. That's a good part of Forex. All right. So, in order for you to succeed, I'm explaining the last point, all right? So, in order for you to succeed in the Forex market, you must be willing to work hard and master professional skills, which is one of these, all right? You master this skill, which I'm telling you right now in this video. I believe up to the end, you'll be able to change the way you trade. You'll be able to understand everything about Forex, right? Some hard work, and also you need to master this. You can save the video, you can get even notebooks, you write notes. Make sure you grasp every information that I'll share in this course. All right, so let's go on. Another business of Forex to continue. The Forex market, like I said, it is open 24 hours, which gives you flexibility to trade at any time when you want. You can build your business from anywhere in this world. You can plan your daily trading routine around your day job, and be able to generate consistent profits of about 5 to 20% per week. You can do that. It's very possible. All right. It's very possible for you to be able to make this amount of money. So the next is the table. I'm sure you're able to see this table. It shows the market trading sessions. So the Forex market, as it is open for 24 hours, but is divided into 4 segments, which are trading sessions. All right. There is the New York session, which is blue in color. There is Sydney, there is Tokyo in green in color. There is London. There is New York. It's a cycle like that. All right. So these times you can see here on top here. You can see here on top these ones, 1, 2, 3, 4, 5, up to 12. All right. So these are trading times, and this one is Eastern Standard Time. All right. These are Eastern Standard Time. So the New York session is open at 01. All right. Sorry. The New York session is open at uh, let me start with the London. Sorry, let me start with the London. The London session opens at 4 p.m. All right, at 4 p.m., which is Central European time. This is 9 hours. All right, this is 9 a.m. 9 a.m. If we put it in Central European time, this is 9 a.m. and Eastern Standard Time, this is 4 p.m. So it opens at 4 p.m. the London session, and it ends at 12, which is actually 15:30 Central European time. 15:30 Central European time. Then there is Sydney, which opens at 6 a.m. and it closes at 2 p.m. And now we've got a Tokyo. Tokyo, it opens at 8 a.m. and closes at 4 p.m. We've got the New York session that opens at 9 and closes at 5 a.m. All right. All right. If for which Central European time, New York session opens at 15:30 and closes at um, it closes at 23 hours. All right. So this one is a market session. All right. It's a market trading session. So you can check even on the internet, you can check for Forex market trading converter, where you put to your own time frame and is able to, for your own trading zone, and is able to tell you according to your time zone. All right. All right. I guess this is clear. This is clear. I believe so. So now in the Forex market, like I said, that we trade currencies. It is a platform where currencies is being traded. So now um, currencies, they are actually uh, each currency is actually given a three-letter code. All right, each currency is given a three-letter code. A three-letter code. What do I mean? Look here. There is pound. Sorry, there is euro. There is US dollar. There is the pound. There is Japanese yen. There is Swiss francs. There is Australian dollar. There is Canadian dollar. There is New Zealand dollar. So what happens is each currency uh, each currency in the forex market is being donated by three letters. So euro, instead of the four letters, but it's three, which is EUR. That's what I mean when I say three-letter code. EUR, USD, GBP, JPY, CHF, AUD, CAD, NZD. I believe you can see now. So three letters, okay? Now the two currencies, they make up a pair, all right? Just like a man and a woman. They make up a pair, which is a couple, all right? So now the currency pairs are always in two. They are two, 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 two. As you can see down here, as you can see down here, as you can see here, okay? Three, Euro USD, GBP USD, USD JPY, USD CHF, AUD USD, NZD USD, and USD CAD. All right. So these ones are pairs. All right. Here another pair, another pair, another pair, and the last one. Okay. So now, why did I pick just 7 currency pairs? These are the most traded and liquid pairs which most traders do trade. All right. They actually show clear movement. All right. They show you clear movement. So these are the most traded currency pairs in the forex market, the 7. They are also called the major pairs. Okay. All right. All right. All right. All right. All right. Okay. Okay. So for example, here this is a currency pair. Okay. So now forex market being buying and selling. So every time we are buying a currency, we are selling a currency. Each time when you place a trade, you are buying, you are selling a currency. Now on a currency pair, the first currency, which is in this case is euro, is called a base currency, and the second currency is called the quote currency. All right. All right. So you can see here there is 1.35052. All right. So this one simply tells you that This one simply tells you that for you to be able to buy the first, which is the base currency, you'd need $1.3505 for you to be able to buy €1. This is the meaning. All right. Then if you check here, you'd find that there are 4 digits after the decimal place. The number 4 figure, which is 5 in this case, is called a pip. Get this one correctly. I will repeat it again. Here, Euro USD is equals to 1.3505. This simply means that for you to be able to buy €1, which is the base currency, you'd need 1.3505 quote currency, in this case, which is dollar. So you'd need $1.3505 for you to be able to buy €1. And the number 4 after the decimal place is called a pip. All right? It's called a pip. Now, there are other currency pairs that goes up to 5 digits. So the number 5 digits is called a millipip or a fractional pip. But this one, don't mind it so much. Mind so much the pip. All right? Okay. This is what I'm just from explaining. Okay. So now, let me explain something about a pip. Wow. All right. I said that most currency pairs, they've got 4 digits after the decimal place, except a pair that have got a Japanese yen. Japanese yen, they don't go up to 4, they go up to 2. So on the Japanese yen, a pip is the second number after the decimal place. Get this correctly. With currency pairs with Japanese yen, a pip is the second number after the decimal place. Why? Because Japanese yen currencies, they don't go up to 4 digits after the decimal place, just 2. And the last one, which is the second figure, is a pip in this case. Here is an example. So for you to buy $1, which is the base, you'd need a quote currency of 98.73 Japanese yen for you to buy $1. Now, why is a pip here? A pip is number 3, all right, which is the second number after the decimal place. That's a pip. And the 4 you are seeing here is the fractional pip. And don't pay attention on this one. All right. You can see. Here it is. This is what I'm just from explaining. All right. This is same thing, what I'm just from explaining. Okay. All right. So here, I think it will be important for me to explain these notes down here. All right. So I know somebody was having questions. What is a pip? How do you define a pip? Okay. A pip is simply a short or abbreviation which is the price interest point. A pip. Okay. The price interest point. So a pip is a smaller change in the value of any given forex quote. for which any pair with Japanese yen, the pip is a second number. And the currencies with US dollar as a quote currency or US dollar as a base currency is the fourth number. That's a pip. All right. For example, let's read the second point under pip. So for all non-JP Forex pairs, one pip represents the fourth decimal place of the quote. E.g., when Euro US dollar moves from 1.3505 to 1.3506, you can see a change on the pip by 1. So it is the movement of 0.001 or 1 pip. All right. So meaning there was a change here. So a pip is 1. Why? Because there was a movement of 1 pip. Okay. But now for JPY Forex pairs or Japanese yen, 1 pip is represented by the second decimal place of the quote. E.g., when US dollar JPY moves from 8.55 to 8.87, you see? So the 7 and the 5, there was a change there. So we made about 32 pips movements. All right. Okay. I believe this is clear. So there was a change of 32 pips. Okay. In case you have any question, you can hit always the comment section and I'll be able to respond to you as quick as possible. All right. So now, without forgetting this, when you open an account with a broker, you are given an opportunity to choose with what type of an account you'd want to open, whether you'd want to open a cent account or you'd want to open a micro account or you'd want to open a standard account, which I recommend mostly to open a standard account. So under standard account, when you place a trade, for example, with a one lot size, okay, one lot size, okay, one lot size, which is 100,000. One lot size is denoted by 100,000. So, for example, you want to buy €1 and you place your trade with a one lot size. That simply means that you'd need dollars that will be able to buy for you €100, 100,000 euro. Okay? And meaning that each movement, okay, get this correctly. If you place a trade with one lot size, it means that each movement, each change of your pip, for example, if there was a change of 1 pip, that simply means that you've made a $10 profit if the market goes in your favor. If your market go opposite direction, that simply means that your account will be negative, will be a negative by $10. Why? Because one lot size, it means that each movement, each change is equivalent to $10. This is what it means here. Okay? Don't worry, I will explain you and you'll be able to understand. Okay? This is what I was just talking about. Standard account, it means 100 units, 100,000 units. Main account, 10,000 unit. Micro, 1,000, and nano which is 100. All right. So a standard lot is actually 1,000 units of the base currency. Okay. E.g., when you buy one standard lot of euro US dollar, you are buying 100,000 euro with US dollars. Okay. I believe this is straightforward. I believe this is straightforward. So let's try to do calculations. How to calculate your profit. So how do you calculate your profit? You need to know, one, the number of pips. Okay? You need to know the number of pips and also the lot size that you've placed the trade. All right? And you also need to know the value per pip per standard lot size. And I told you that if you place, for example, with one lot size, it simply means that the value per pip is $10. All right. So the value per pip per standard lot size is $10, or about $10 for most of the active traded pairs like Euro USD, GBP USD, Australian dollar, and also USD. You can still check on you can still go to this website in order for you to find out value per pip per lot size for all major pairs. You can just simply go to this website. They'll be able to to show you. All right. Okay, this is what I'm just from explaining. Okay. All right. So let's say, for example, we are buying Euro US dollar at 1.3510. We are buying, let's say, with one lot size. So what we do, we've bought at 1.35 10. Let's do this. Okay. Yes, here. Yeah, I think I tried to illustrate. So now let's say that we buy at 1.3510 and we cross our trade on 1 point here. Okay. Let me do this. We cross our trade here, then we've opened our trade here. So meaning that would need to know how many pips. All right. So now 1.3550, we subtract, okay, we will subtract 1.33 1.3510, right? Then we subtract, then we'll find that there are how many pips? We'll find that there are 40 pips. All right, there are 40 pips. Then these 40 pips, we need to multiply it with the standard lot size value. Okay, in this case, one lot size, it means that each movement per pip is equivalent to $10. So now we put that $10, all right, times the number or the pips value, which is one lot size. So it means that this movement here would have meant a $400. So those who placed trades here and closed at 1.3550, it means that they made a profit of $400. This is not just a matter of calculation. This is the reality. This is the real about this business. All right. So this person here made $400. Okay. You see. So the 10 is the 10 is simply the value per pip per set per standard lot size. So one lot size, you need to know, one lot size is equivalent to $10, meaning per pip, per movement or per change, it will be equivalent to $10. Okay. Okay. So this is how you profit from forex moves. Let's say you go long with one lot size contract at 1.3510, then you've sold at 1.35550. So this simply means that you subtract 355 minus 3510, which will give you the 40 pips. Then if 40 pips, you multiply it by 10, then you also multiply it by 1. All right? So it will give you $400. Okay? It will give you $400. All right? So you can still look at it in another way. You can still look at it in another way. So you've placed your trades, you've released in other ways your money, and the money you released was 13,000. It was 135,100. You've released that money. All right. So here in this case, we've removed the points. Okay, we've removed the points. Yes. So we've released the monies at 13,510. Then we've received a 13,500, sorry, 135,500. So meaning that what you do, you just have to subtract, all right, which will give you a 400,000 US dollar. As simple as that. As simple as that. And you are right in the right. Okay. And you're right in the right. Same thing here. So this person placed a sell order, which was at 1.3560, and they've come out of the market to close the order on 1.355, 1.3520. Then you multiply it by the pip value. Okay. The dollar value per pip per standard lot size, which is 10. So 10 by the standard lot size that you used, which is 1, then it will give you a 400. So in case someone may be asking me question, where am I finding 10? These ones are numbers that are given specifically for the lot sizes. All right. So if I place a trade with 0.1, it will mean that each movement, it will be $1. Okay? One lot size, each movement is equivalent to $10. Then if I place two lot size, that will mean that each movement it will be $20. If I place a trade with $50, sorry, 50 or 5 lot size, that will mean that each movement, for example, if it changes by 1 pip, that 1 pip is equivalent to $50. That is where these things they are coming from. All right? They are just things that are given to lot sizes. It's not something that is calculated for you to get it. Yeah. Yeah. Okay. Still explaining same thing. Same thing that I'm just from explaining. Okay. So now our next is power of leverage. Why do you need to go for a broker that gives leverage? Very, very important. All right. Very, very important. So in Forex, brokers they allow traders to leverage up to 1 to 100, but others say go up to 1 to 1,000, others up to 1 to 500, depending on the broker that you are using. Now, what's the leverage? The leverage is simply mean that the broker gives you, I would put it like a bonus for you to be able to buy base currencies, even when you've got a small quote currency amount. All right. Let me read here. So in Forex, brokers allow traders to leverage up to 1 to 100. This means you can buy or sell USD of about 100,000 with just 1,000 margin. Okay? All right. So in this case, let's say you've got a 1,000 in your balance. But in Forex, you are allowed to buy even 100,000 US dollar, for which in real life you are not supposed to be able to buy. Why? Because you've got less balance. But this is the good part of our Forex. It will help you to be able to buy more bags than your capital. And that same figure that is given to you to be able to buy more bags than your amount, that's what we call a leverage. So in most trading situations, we usually only leverage up to 1 to 20. This means with a 10,000 USD account, we can able to buy or sell up to 200,000 per trade. This is all that is required to achieve exponential high returns. Okay, so 1 to 10, this means that for you to be able to buy, let's say a $50, you just need a 10% of the required amount for you to be able to buy that $50. All right. Let me give an example. Let's say you want to buy a car, and that car is costing $20,000, right? It's just an example. That car requires you to have a $20,000, okay, for you to be able to buy it. Now, a company then decide to say, okay, no, instead of you paying that 20,000, what you need to do will give you a 1 to 10 leverage. So this simply means that what you need is just 10% of the amount of that 20,000. The rest of the amount will pay for you. That's what usually brokers are doing when they give us leverages. All right. So 1 to 10, 1 to 20, sorry. So 1 to 20, this simply means that all you need to do is you just need a 5% for you to be able to buy that car. And the rest of the money, the rest of the 95%, the company itself will pay for you. This is the meaning. 1 to 50, you just need a 2%. 1 to 100, you just need a 1% of the required amount for you to be able to buy that vehicle. That's what it means, a leverage. All right. So now in the Forex market, there are what we call trading types or kinds. So as a trader, it is very important for you to define yourself. What type of a trader are you? Now, most of the people, they just go and they start trading without even defining first themselves to say, who am I? What type of a trader am I? You need to understand. You need to know yourself in order for you to be successful in the Forex market. How long will your trades take? Do your trades take 2 days? Do your trades take hours? Do your trades take just minutes and you're out of the market? You need to define yourself. So there are 4 types of traders, which is 1, the scalpers. The scalper traders usually their target number of pips is 5 to 15 per trade. And their trading duration usually is just seconds, minutes, and the time frame that they use is 1 minute and 5 minute time frame. Okay? So you need to understand this to say how long is the trade going to take and what is the target? What is my target pips? If my target pips is just 15 pips, then I need to analyze the market on the lower time frame, which is 1 minute to 5 minutes or 15 minutes. All right? There is no way you can target 200 pips or you are targeting just 20 pips. Then you go on time frames like like 1 hour, 4 hours, day. It means you'll be able to lose the account. So the first thing you need to know, 1, your account size. Then you define yourself. What type of a trader are you? All right. Then we also have swing traders. Swing traders, their target is 50 to 150 pips per trade. The duration is less than a week chart, which is 1 hour and also 4-hour time frame. We have also the day traders, which their target pips is 20 to 40 pips per trade. Then their trading duration is within a day chart. Then they trade on 15-minute time frame, 1-hour time frame, and also H4, which is 4-hour time frame. Then the last one, we also have the position traders. Their target is 500 and 1,000 pips per trade. So the trade duration is weeks to months. All right. Then their time frame that they use is day candles and also 1 week. So these are types of traders who can place a trade right now, today, and they are planning to close the trade after 5 years, or even after 2 years, or even after 1 year. Okay. So for you to be able to go for this type of trading, you need quite a good amount of money. All right. So we are going now to the trading strategies now. I'm going to share with you the 5 powerful candlesticks that I use, candle patterns that I look at on the chart for me if I want to place a trade. So the forex market, we actually analyze it on three types of charts, and these are bar charts, the candlesticks, and also line charts. But most traders, they've been going for candlesticks. Why? Because candlesticks, they communicate a lot than the line chart and also the bar charts, right? And here is an example of candlesticks. This is an example of candlesticks. This is how candlesticks looks like, right? These are candlesticks, okay? Okay. Now, why do we go for candlesticks? It's because candlesticks, they are very easy to read. All right, they are very easy to read. Candlesticks charts reveal stocks opening, closing high, and low price. Okay. So we are going to do a study on the candlesticks. Um, so there are three different ways you can analyze the market by following either one of the three types of charts, which is the line chart, the bar chart, and the candlesticks ones. And I prefer using candlesticks. Why? Because candlesticks, they communicate, or they avail a certain or a lot of information about the market. The candlestick charts, they reveal a stock opening, closing high and low price. They are also powerful sentiment indicator that shows bullish or bearish bars in the short term. All right. So in the forex market, there is what we call the bulls, and also uh, the bulls, which are also the bullish, and the bearish. All right. The bearish, usually they push the market going down. They are they are what we call the sellers, and the bullish, they are what we call the buyers. All right. So so um so in this case, I've got two candles here. There is the lady and also the white candle. Okay, so the white candle will represent the bullish, and also the red candle will represent the bearish. All right. So the entire part of the candle, let me show you something. This part is called the range. All right. The range is simply the whole part of the candle. Okay. Then there is these things, the wigs. These ones are wigs. All right. So those ones are wigs. Then there is also the body, which is this one here. This is the board. Okay. That's a board, as you can see. I've shown here. That's a board. Then on the bullish candle, usually the opening is down here. Let me do this. So it opened from here. It went like this. There was rejection. Then it started going up, forming the body. It went up. Then it came down. Then it crossed here. Here. All right. So it opens like that. This is the open. In case if there was rejection, it goes like that, then another rejection, then it crosses here. So this plus this, it forms the body. All right, so this one is a bullish type of a candle. Then the bearish type of a candle, it opens from the top, it went up like this, then it comes forming the body, then rejection, then it closed here. So this is the closing of the bearish candle, and the opening is on top here. So this will join them like that, will form the body. So this is the body, which is this one here. All right, these are bodies. Okay, so candlesticks, they relay a certain information that as a trader you need to understand. It gives a clear and perfect analysis strategy. All right, so now in this course, as part of the course, I'm going to show you the 5 powerful candlesticks that I use. All right, the 5 powerful candlesticks that I use to analyze the market, that gives me the market direction. All right, they give me a market direction. The first candlesticks that I'm going to review to you are the bullish pin bars. All right, these ones are bullish pin bars. Okay, as you can see, this is how they look like. This is how they look like. The pin bar, they've got a small body and they've got a long tail down. All right, they are like this. This is how they, this is the tail. So they've got a long tail and a small head. Sometimes they don't even have a head. You find it's just like this. Sometimes they're just like that. That's how they look like. All right, so sorry, so the bullish pin bar, they are in form of a pin, or they are in form of a hammer. I'm sure all of us, you've seen the hammer, how the hammer looks like. All right, now, okay guys, let me make a video specifically on candlesticks. Let me make a video specifically on the candlesticks. Please, if you are not subscribed to the channel, subscribe to the channel. I'll finish this course where I know I've started the candlesticks. In the next video, I'll be explaining on the candlesticks, where I'm going to give you the 5 powerful candlesticks that I use. So subscribe to the channel. Subscribe to the channel. I'll be able to finish this course. All right. Just in case, there's this book I've written, The Secrets to Forex Exposed. This book is really an amazing book, very, very amazing book. There is information in this book that as every trader is supposed to know. All right, if you're interested in this book, you can just comment and I'll be able to give you details on how to get this book. There are actually 2 of them. There is also this one, which is the proven money making forex strategy. In this book, I have revealed 3 trading strategies that you can use to trade boom and crash. You can use to trade currencies. You can use to trade gold. You can use to trade any stock. If you are interested, you can just hit my inbox and I'll be able to, you can just comment and I'll be able to give you the I'll be able to give you the details on how to get this book, especially this one. This one is a must for every trader to have it, because it reviews why the market behave in certain ways. Why is it like you place a trade right now, you've predicted that it's going up, all of a sudden it goes against you? Does it mean that there are people who are manipulating the market? All that information, you find it in this book, and how you can avoid such kind of movements. All right, guys, see you in the next video. Thank you.